the buzzword, the key word of this. We've heard it over and over again from our guests. Give us your take on SPACs.
And I'll give you a different spin on it. SPACs are a symptom of a market that's not functioning properly. It's Wall Street ingenuity trying to figure out how to get companies public when the traditional IPO process is failing. So that tells you that Congress and whoever is going to be occupying the Oval Office needs to fix the stock market structure so that we can get support back into smaller IPOs and be able to take them, distribute them properly, do a proper underwriting, and get them to set up and support it back and get America back into business. Now, we worked on a new form of stock market that was supposed to do this. That was in that bill I told you about that made it through the House 406 to 4. It was called a venture exchange. It was with Congressman Emmer, Republican but it was very, very bipartisan up in Minnesota. And it was in that big omnibus package that got stalled when it went over to the Senate and the president shut down the government over the wall. Hopefully it'll come back. But SPACs, right now offer people an alternative to get public. And if there are more and more and more of them, we'll get more companies public. It'll create some velocity of capital to mid-sized companies. So on the margin, it's better than nothing, right? But the trick is there's a lot of dilution associated with it, which puts a limit on it puts a big pressure on buying a cheap company into the SPAC to get the conversion, to de-SPAC it, to get real investors to buy it. And then you typically have a warrant overhang or a partial warrant overhang. And so you got to see a lot of growth in these things to be able to drive through that incremental dilution to make the stocks perform in the public marketplace. And so, as I said, it's not a perfect solution. The flip side right now, and I'm going to connect some dots for you, is that there's probably 60 institutions that generate 90% of the commissions to the typical Wall Street public equity operation. 60 accounts. And the reason, and they are the ones that are effectively paying for access to the IPO calendar, right? But they're not the natural buyers. The natural owners of these stocks are lower turnover. The other, there's another 3,500 accounts out there that are doing more fundamental investment, but because they don't have the velocity in their portfolio, they're not generating enough commissions to get access to the IPO calendar. So what is Wall Street doing? Wall Street's chronically underpricing IPOs to those top accounts of theirs. They generate a pop in the stock price, and they are shaking them down for commissions over the transit. That's what's going on. And they may not say that, but basically they're saying, things like, we're only allocating new issue equities to our big commission payers. Well, what are they doing? They want to see more commissions. If I put $1 of alpha into your account, I want 50 cents back into my account, right? And so what's happening is the companies that are going public in that process are being underpriced, leaving too much money on the table. Boom, boom, boom. Now you hear about direct listings. What's going on? Well, people in Silicon Valley have figured out that they're getting screwed. They're getting way chronically underpriced and not properly distributed. So they want to direct list and avoid Wall Street altogether. And that's that tension. So meanwhile, you got SPACs showing up in the market to try and fill the gap. And so all of this here is telling you that stock markets are not functioning properly from the perspective of capital formation, and we need to go out and start with a clean piece of paper and structure a market that is going to allow people to provide aftermarket support.